Good afternoon, everyone. Thank you for dialing into the first session of our Prospectus 2021 conference. This is the first conference where we've brought together Artemis and Reinsurance news to try and give a view across both traditional and alternative sides of the industry on some of the key issues that people are thinking about today as we move towards 2021. Hopefully you're all in and can see the video fine. You can move things around on the screen in front of you, adjust the size of the video window, and there is also a Q&A box. You'll be able to ask questions of our panelists during the session as well. We'll probably get to those questions at the end. So for this first session, we're looking at the COVID-19 pandemic, obviously the hot topic of the moment, given the impacts to the global economy from both a life and livelihood point of view, and then onwards to the insurance, reinsurance, and also ILS industry. The pandemic has obviously rocked the entire globe, and the industry is going to not just feel the effects, but pay a share of the financial costs and support people and governments in getting back to normal. But as we move towards 2021, there's a great deal of uncertainty still over where the final costs for the industry will eventually lie, how COVID will impact the industry's ability to operate going forwards. It's been such an enormous change for an industry that works face-to-face a lot of the time. How do we meet client needs still, and how do we also meet demand and new demand as well, given this new peril of pandemic that people maybe were not so focused on in the past? So on the liability side, there's questions over, obviously, the retrocession and ILS market and how that will be affected towards the end of the year, while in traditional reinsurance, could second waves be treated as second events, and when do the losses stop flowing, or have they even really begun yet? So all those questions and more to answer in this session. And I'm delighted to be joined by a number of experts from both sides of the industry, representing a number of different participants. So we have David Flandreau, Managing Director of Analytics at HX. We have Joanna Soroka, Director of New Markets at Firmat Capital Management. Peter Giacone, Managing Director and Global Head of Insurance at Kroll Bond Rating Agency. And Linda Johnson, Head of the Legacy Practice at Tiger Risk Partners. So thank you to the panelists for all joining me today. And with that, we'll move straight on to some of the questions. So to begin, it would be good to hear some views on sort of how the industry has coped so far with the unprecedented effects of the pandemic, being the first, obviously, in decades to affect the industry in this way. And Peter, can we start with you, perhaps, for a summary of the impacts from the rating agency point of view?
Absolutely, and thank you, Steve, and thanks to all our participants who are watching us today. So I guess as I was thinking about today's panel and thinking we're almost at the 6-month mark of this pandemic, and a very unique situation, and I think back to how we were looking at it and trying to grapple with the issues back in March and April. And I think now with the benefit of 6 months of hindsight, I think the industry has actually fared quite well. From a credit risk perspective, I think there was an awful lot of hand-wringing that was going on at the time. There was a lot of concern around how both assets and liabilities would behave. We tried to keep a very steady hand at Kroll with respect to taking rating actions, and I think that's proven to be the right course here. I think the asset side of the balance sheet has sort of stabilized a little, obviously with quite a bit of volatility. Uncertainty continues, but we think a lot of that is behind us in terms of the recovery on balance sheet. So some of the short-term concern on that front, I think, has somewhat subsided, but we'll obviously have new challenges in terms of low interest rates, and I know we'll talk about that later on the panel. And on the liability side, I think also, again, lots of uncertainty, but some of the very large numbers that have been bantered around initially, which I think made sense at the time, certainly. I think we're at a point now where perhaps some of those are not where we're going to land. And so I think that's good news for the industry overall. So I think, from a reinsurance and ILS perspective, what we see from a credit side is things have sort of stabilized a little bit, and we're sort of hopeful that the resiliency of the industry will continue into 2021. We'll talk to some of the drivers and factors on that as we go through the rest of the panel today.
Great, thank you, Peter. And so moving to you, David, I know you and your team have done a lot of work looking at the impacts of the pandemic and the losses the industry's faced. But where do you foresee pressures arising in 2021, given elements like the lower for much longer rate environment and also the uncertainty over how long claims are going to flow for, and where they're going to come from as well, even.
Yeah. Well, the market that we're in right now feels somewhat paradoxical. The price rises that we're seeing, I don't think are necessarily driven by a dearth of capital like they have been in previous cycles. They are driven by perceptions of risk premia. And all of those things that you just mentioned, the potential for COVID losses to develop adversely, the possibility of heightened catastrophe losses that we've seen in recent years, an economic slowdown, difficulties with top line, falling interest rates, the drying up of reserve releases that were so beneficial to the sector between 2012 and 2017. All of those things, sorry to sound like Dr. Doom, all of those factors together really are contributing to this sense of heightened risk premia. The other thing that is contributing to it is the fact that for many classes of business in commercial, specialty, and reinsurance lines, we're coming off multi-decadal lows in price. Let's not forget that. And that is driving additional pricing appetite, if you will. So it's really that combination and amalgam of effects that that are creating this perception of heightened risk premia. And I would just say that, as we have seen the real data coming in some areas, for example, claims data for COVID-19, the last tally that I saw of publicly reported claims data still has the total under 30 billion. I don't want to be sanguine about this, but I'm old enough to remember when people were predicting 200 billion on the asset and liability side. Oh, can everybody still hear me? I'm sorry, we had a little freeze there for a moment. And I just think that there is actually still some upside risk here, not to be too sanguine about it. To contradict myself, one downside risk is also top line. And we can talk about reinsurance and specialty insurance, but really it's the commercial and wholesale and retail market in particular that feed everything, and not least auto insurance. And if we start to see premium volumes and top line volumes decreasing further, that could be particularly worrying. Now, macroeconomically, we are, especially with the news of the vaccine in the last few days, we are starting to see a real uptick in economic expectations, particularly in Asia and in the United States. And with the election, people have a different outlook on the macro political environment. Both of those things could be positives in 2021. So I guess the only answer I can give you, Steve, is uncertainty. There's a lot of on the one hand, on the other hand going on. And I think, again, I'm just going to say it one last time, these price increases are not being driven by a dearth of capital. They're being driven by what have been heightened perceptions of risk.
Which is a much more healthy response than just raising prices for the sake of it, of course. Thank you, David. Great overview from you and Peter there. So Linda, going to move on to you now. Thank you for joining us. So from your vantage point at a reinsurance brokerage and capital advisor, and your focus on the legacy marketplace, are you getting much of a feel for sort of the length of the tail of COVID yet?
Yes. Well, thank you, Steve. Thank you for having me. And thank you to my co-panelists. The tail, I would say, on many emerging longer tail losses, as a rule, the tail is always longer than initial projections. And as David said, in this case, the initial ultimates seem to be shorter than the initial projections. For COVID, things that will, and again, the tail, we have the insurance tail, but then we also just have the social economic loss and the tail associated with that. We will have, the event will be extended with things like the vaccine and different treatments, and certainly there will be winners and losers in that will extend the tail. I think for any illness, you also have the long-term ramifications of consequences, 20 years from now, post-illness. How does this loss impact children or certain parts of the demographic? I think we need to be prepared for the unknown unknowns. I think in terms of mental health issues, one of the early symptoms is a severe headache. What does that mean long term? You hear about kind of brain fog associated with the illness. How does that impact children versus young adults? versus nursing home residents. So I think that the tail will certainly go into the future of our children. That said, the insured loss tail could be quite a bit shorter.
Sure. Thank you, Linda. So yeah, it's interesting. Obviously, there are two sides to the pandemic, economic and insured, and then social and also mental health issues as well around this. And in the UK here, you can't read the newspaper any day without reading about what they're now calling long COVID. So the tail of the pandemic is clearly becoming apparent to everybody. Yes, David.
Yeah. Sorry to interrupt. Just listening to Linda there, and I know, Linda, that you're saying all those things, in the most analytical way possible, but it's really scary. If you think what Linda said about the insurance tail is probably going to be short, but then mental health and children and what are the unknown unknowns, that is, for me, really quite frightening just to hear Linda say that. So you can imagine, multiplying that concern about all those things, mental health, long-term effects, children, unknown unknowns. That is what is driving the fear in the market, not the boring capital levels and liquidity levels and premium levels and values at risk that we normally talk about in insurance. It's really a macro concern about all of those unknown unknowns that Linda mentions. I think that's more important right now than just about any other market dynamic. Sorry to interrupt.
Thank you, David.
Actually, I agree with you, David. I agree with you, David. I think the way that's a great point.
Okay, thank you. So we're going to move on to Joe now. So Joe, obviously you bring the ILS markets hat into this discussion. So how long do you think the pandemic overhang could remain in ILS circles, both in terms of claims potential, but also in making the capital raising environment more challenging, which I know has been right the way through this year, really, for most funds?
Hi, thank you, Steve, and hi, everyone. It's great to be here for your first Prospectus conference, Steve. So in terms of ILS and the overhang of COVID, obviously the ILS market is very broad, and it depends which segment of the market you're talking about. The less liquid part of the market, investments that back collateralized reinsurance or sidecars or retrocessional agreements, those are the ones that have been most impacted by potential COVID claims and therefore trapped collateral expiry. But the more liquid part of the ILS market, the catastrophe bond market, has emerged relatively unscathed. Cat bonds are in general named peril transactions, and apart from very specific examples where these bonds target pandemics and excess mortality, they generally don't cover pandemic risk. So in March, when the financial markets were reacting to the pandemic, we saw a sell-off in the cat bond market. Some investors needed to redeem, to rebalance their portfolios, or to tactically deploy capital elsewhere. But that created secondary buying opportunities within the market, and it soon stabilized with minimal damage. So in terms of overhang, there is no overhang on the cat bond side of the ILS market. We see investor interest is very strong. Investors obviously appreciate the low correlation that the cat bond side of the market has shown to traditional asset classes. And they appreciate the liquidity of those instruments that clearly can be traded in all sorts of market environments. On the less liquid side of the market, I think their investors are focused on exclusions, if only to make sure this time next year we're not in the same situation if there's another wave of pandemics and another wave of lockdowns. And I think the market can demonstrate it's doing that, and to the extent possible trade forward, then I think we can get this COVID-19 impact from the ILS perspective behind us and that overhang behind us, perhaps towards or just after the end of next year, 2021, and maybe early into 2022. But at the end of the day, ILS investor interest is still very high in the space, and we believe investors can be forward-looking on issues like this.
Sure. And for some investors, like David was saying about heightened risk perception in the marketplace as a whole, there's also a heightened perception of potentially the good they can do with bringing risk capital to market as well. Thank you, Joe. So we're going to move on to Peter again. So In terms of moving into 2021 for insurers and reinsurers, in a world that's still going to be experiencing significant economic impact, it seems like, although there's the beginnings of evidence that as lockdowns do lessen, which obviously we all hope they will do into next spring, at least in the Northern Hemisphere, that we will see some economic recovery coming through with that as well. But what are the key issues and decisions that reinsurers need to be thinking about moving towards 2021?
Yeah, no, and just to pick up on the point David was making earlier, and Linda and Joe as well, that there is sort of this global pandemic, global overview and global paradigm that everyone's looking at the world through a very, very, very different lens than they were 6 months ago. So I think everything we're talking about has to be viewed in that context. But having said that, I believe that there's almost going to be a focus back to basics on a lot of the very fundamental issues that drive the profitability of the business. You know, things that are less glamorous, like contract wording, is going to receive a tremendous amount of focus. I think, you know, for the players in this market, there's going to be the data on all of this, which is starting to come in, is going to continue to flow. It's going to take time, hopefully sooner rather than later, but some time for all of the risk models to pull all that information in so the industry can recalibrate and decide on pricing and decide on premium levels and decide on how much exposure they want to retain. And by the same token, in the ILS market, the creativity, which has always been sort of the bedrock of that market, is going to come to bear here as those risk models get updated. I expect to see that there would be new and very creative and new structures that get put forth that satisfy a need in terms of risk mitigation, at the same time find a demand among investors, because I do agree with the point Jill made. There's a lot more interest in this market than there was previously because of some of the uncorrelated performance of those securities over time. I think, again, low interest rate environment, we've mentioned it. Our brethren over on the life insurance side have already come to terms with it. They have, I think, fundamentally, almost in this industry, accepted that this is the new normal. And I think there are going to be select players within this market, especially reinsurance, those who maybe take more of a total return approach, who might be well positioned to figure out ways to navigate that low interest rate environment. I'll be interested to bet my panelists have views on that as well. And I think finally, the challenge would be to think forward for the next 18 to 24 months. Models are going to take time to catch up. To my earlier comment, I do think we are entering sort of a phase where, given the capital base, things will remain relatively stable from a credit risk rating agency perspective. I don't see a lot of volatility in the near term over this, but I think, again, as those long-term effects start to take effect and as strategies start to shift, you may see some changes in the output. But again, near term, I think we're pretty seeing a lot of stability going forward, and obviously with the vaccine on the horizon and a few other of the positive news, noteworthy news items, again, we have a reasonably stable outlook for the industry going forward.
I'm just going to say I apologize. I fell off there for a minute, but I'm back. I hope everybody can hear me.
Thank you, David. Yes, we can hear you, and thank you, Peter. David, as you're in the frame, let's turn to you. What's your view on sort of second events for reinsurance under sort of second waves of COVID? Is there any concern there, do you think, for the industry? I know a couple of big reinsurance buyers have in the past said that they would seek to classify second waves as second events if they could.
Absolutely, and I think that I think that the wind is at their backs at the moment, given like we described earlier, the risk premia that are in the market. So if you're in the market seeking second event cover for certainly non-damage BI pandemic risk, or specifically in regard of COVID, it is difficult to obtain. But I suppose you're talking about contracts that are already in existence. And I see. Forgive me for just parachuting back in here. Contracts that are already in existence, that's right. That could become litigious, especially as we get farther and farther away from the initial lockdown in March. Is it a second event, or is it all part of the same pandemic? There will be arguments on both sides, and I would anticipate that we will see some of those arguments in court now that we have had a second lockdown in most countries. I don't think that's earth-shattering to say that. think that's just going to be the normal course of events as we go through the claims process. The interesting question that falls out of that, though, is the interest in non-damage BI cover worldwide, and how do we underwrite it? Can we underwrite it? And what are the wordings and time clauses around it? So that's something that the industry is still grappling with. I could go into excruciating detail, but I think those are the high level points.
Sure. Thank you, David. We'll actually talk about that probably a little later on in the discussion as well. Joe, from the ILS point of view, do you have any sort of thoughts about second event covers or anything like that? I know the cat bond market obviously, again, would feel has no exposure at all to this type of thing, but potentially on the collateralized side?
Yeah, so you asked earlier, Steve, are there any concerns? Of course, there are always concerns if there's potential losses, but I think the more pertinent question is, there any surprises for ILS investors? And when it comes to the topic of second event cover, it's something investors have had experience with before, going all the way back to 9/11. So there's no surprises there. They're aware of this potential. As David explained, second event depends on many things, on wording, on risk period, on cedents, on lines of business. But at the end of the day, I think the investor experience is, of course, that these are ultimately follow the fortune contracts, and that's how it will end up here as well.
Yeah. Thank you, Joe. So, Linda, moving on to you, it does seem like legacy solutions, such as the ones you focus on, are going to be part of the solution going forwards for helping the industry to eventually put COVID behind it. How do you think the legacy and the runoff market will deal with this? Will there even be an appetite for taking on exposure to the pandemic in legacy deals further down the line, do you think?
Yeah, so legacy deals include lost portfolio transfers, adverse development covers, and then you can kind of go out and include some, dispositions of portfolios. We've seen syndicates that have been sold, Part 7, Section 13s. So within legacy, it's a pretty broad topic. And I think one of the key things that the legacy market is bringing right now is that release valve for capital. So you can purchase a legacy cover on an older portfolio and get that additional capital available to you to just shore up your entire balance sheet, give you the capital to write future exposures, and not necessarily have to have the 2020, 2019 COVID-related exposures included. So I think that it's a very robust market, excluding the COVID, because we are in this very high period of risk. And so an important lever is to de-risk your balance sheet by getting rid of some old reserves. Specifically to the COVID-related lines, the pricing will become more efficient as a little bit more time passes. Right now, we are having transactions that are including 2019, which would certainly be on the lighter end of the COVID exposures. But I do see that we will find solutions for those during 2021, 2022. There was a mention of the low interest rates. The low interest rates are severely impacting these transactions, and the time value of money is nothing like it has been historically. So you have a high risk period, a low investment return period. That's going to drive the costs of the legacy covers up just in isolation. But if you look at it relative to a marginal cost of capital analysis, there are some really good transactions still occurring. So we have some very large balance sheets out there writing reserve covers. We definitely have an abundance of capital available. That said, we should expect that people are smart, that they are taking responsible, calculated risk, and they are going to create solutions, but they're not naive capital right now.
Sure. Thank you, Linda. And I guess it's going to take a bit of time for people to come to terms with how they would price for some of those potential transactions further down the line.
Yeah, and I think, just the contract language of it, as far as, what do the words mean to whom, and how does that evolve over time as well. I think some standardized language, some common understanding will help with the effectiveness of the market as well.
Great, thank you, Linda. So David, just flipping back to you quickly, I know you often write in your reports and your analysis about returns on equity of the reinsurance market and the fact that sometimes they're not potentially enough or sufficient in a lot of quarters. While rates are hardening at the moment, and clearly everyone's expecting reinsurance in particular to move some of the biggest rate increases in a decade potentially in some areas of the market. Do you feel that's going to be enough to get ROEs back to a level of sustainability?
Well, it's great to listen to. Can you hear me, by the way? I'm just worried about my connection. Yes, okay, yes. Forgive me. It's great to hear Linda talking about the time value of money and the marginal cost of capital and all this. Very, very interesting point in time where we are right now. Reinsurers have, over the last 20 years, exceeded their cost of capital, and then they've gone through fairly long periods where they have not earned their cost of capital. So that is one big argument for reinsurance rates on line across many lines of business to increase. Certainly, there's no doubt about that. And that will be the argument, undoubtedly, that certainly the larger reinsurers will be making at renewal, particularly given the difficulty of earning anything on the non-technical side of the P&L. This being said, I think it really presents, and I think Linda alluded to this when she was talking about adverse development covers, perhaps in particular. It opens up an interesting discussion about capital markets arbitrage, because if we are indeed in an environment where we have retrocession, property catastrophe, risk-adjusted rates on line increasing 20% on 25% a year ago, and if we're indeed in an environment where German interest rates are negative and subordinated debt investors expect yields that are in the single digits, maybe the low to mid-single digits, the question is, can we use the capital markets to securitize reinsurance cover at a lower cost than is available in rated markets? And I'm sure that Linda has had this conversation internally and externally, and it's also one that I am having internally and externally in a number of different areas. There are opportunities in capital markets with post-war low investment rates and post-war low subordinated debt yields to create more efficient capital than may be available in the rated market. The problem is, of course, that capital markets aren't as specific or differentiated or tailored to cedents' needs as reinsurance and retrocession markets are, particularly in the rated paper area. But it's a bigger arbitrage than we've ever seen. And if you look particularly at restricted tier 1 debt in Europe, and you compare it to the implied yield, for example, on the Swiss Re US Wind Cat Bond Price Return Index, there's an arbitrage that's opened up both pre-COVID and post-COVID that hasn't existed before. So I think that we're going to see a bigger entry of capital markets, not in the same way that we did in 2011 and 2012, but perhaps in a broader way going into the post-COVID era. Did I get too carried away there? I'm sorry to get so, maybe I went off topic. No,
that's absolutely fine, David. That aligns with a lot of things I'm hearing in the marketplace, and perhaps also aligns with some of what we're seeing in the catastrophe bond market as well as the moment. I don't know, Joe, maybe you could speak a little bit about that. Have you got a view on sort of how the cat bond market is comparing to traditional covers at the moment? Because it seems to be coming back into favor with some cedents at the moment as well.
Well, certainly from what we hear, the pipeline is looking strong, and the investor demand is strong, precisely as I said earlier. I think that particular type of investment, the liquidity of it was very much appreciated by investors in March when some needed to redeem. And many of those are coming back. And there's a general interest in the asset class for the reasons that my fellow panelists have described. It's an asset class that supports a real economic function, the insurance and reinsurance markets. And there is lots of capital looking for a productive home, and here is one. And I think the growing realization of ESG issues has attracted more investors to look at our asset class. So the demand is there, and it seems most easily that the cat bond market is the one where demand and supply can meet at the moment.
Yeah, it seems to meet the needs of obviously cedents at this point in time in certain areas of the market, but also investors, particularly right now. It seems the cat bond market should benefit from accelerated demand, I think. And maybe sticking with you, Joe, is pandemic coverage just going to get worded out of existence, do you think, at these renewals? I mean, there's obviously, it's already worded out of a lot of the ILS market in terms of the strict 144A cat bonds, but do you think that's going to be moving much more broadly?
It certainly feels that way, Steve. Obviously, for unintended and uncompensated COVID risk, obviously not when it's explicitly targeting the pandemic, it's certainly something investors are looking for because they don't feel they have been compensated for that risk adequately. We recognize that the primary market may be not able to move as quickly as reinsurance or ILS, but it certainly seems that that's the direction we're going in, and that would be welcome. No one wants to take on any uncompensated risks, including ILS investors.
Sure. Thanks, Joe. So just a reminder to our audience that you can submit any questions you want in the Q&A box that you see in front of you. So we'll move on, and actually on a similar topic around sort of obviously exclusions is one way of dealing with pandemic risk, but we're also hearing a lot of very senior people in the industry saying that pandemic is just completely uninsurable, and not even suggesting that at certain return periods or in certain structures it can be covered, just that it plainly cannot be insured. Now, sometimes to me, with my slightly more generalist hat on and not being in the business, it feels like a bit of a failure of the industry to not consider alternative ways of covering this risk. So I'm interested to know what the panelists' view is on the insurability of pandemic risk going forwards. Maybe we can start with Peter on this.
Absolutely. I mean, and I think I understand where those comments are coming from, because I think a lot of that is deriving from where when you say, well, how do you define pandemic risk and what are you actually going to cover? And if your definition turns into, well, I'm covering everything, whatever happens, and it's every possible loss that could possibly be there, well, of course, that's not something you can't insure every single thing that could possibly happen. So I think, given the pervasive impacts of the pandemic on day one and all the lockdowns and everything else, it was very easy to say we can't possibly insure this. I think when you step back and coming back to some of my earlier comments and some of the panelists as well in terms of what they've been seeing, as the data is starting to come in, you now have information that allows you to calibrate that risk. And it's an old chestnut in the capital markets. There's no bad bonds, it's just bad prices. And I think it applies to insurance as well. I think it comes down to tailoring it and coming up with ways to put boundaries around that risk and quantifying it. I think the problem is before, 6 months ago, we didn't have any tools to quantify it. And I'd like to think, as we've been moving through this very difficult period, insurance industry is doing what it always does, is collecting data, it's understanding risks, it's digesting that information, and then starting to come up with some boundaries around how you could price it. And ultimately, I do expect there will be some products that will carve out pieces of this, whether it's a parametric trigger that some clever actuary will come up with, or that they just have to. I have to believe in sort of my heart of hearts that faced with this challenge, the insurance industry and reinsurance and ILS is going to rise to that challenge and come up with some products and solutions that actually address the risk and spread it around. Because the notion that the insurance industry could cover every possible thing that could ever happen, of course, is nonsensical. But can you take this risk, quantify it, put it in a box, and then bring together, again, investors and capital providers and so on in order to get a solution that spreads the risk around and makes it manageable, that ultimately is a win-win for everybody. I think that's eminently doable, and it's something we're going to see evolve over the next 18 to 24 months.
Sure. Yeah, no, I'd agree, Peter. And David, perhaps to you, you spoke about sort of non-damage BI. Is that a risk that you would hope to see people working towards trying to assume?
Well, I would look at this in a couple of different ways. It's interesting to hear Peter say all that stuff. The reason I mentioned non-damage BI, I think that I and every broker have been in the last 3 or 4 months in the throes of product design discussions. And so we brokers are desperately trying to design products, whether it's for non-damage BI, for event cancellation, for other civil authority or civil action risks that we think could be marketable even in the current markets. So That's the first thing. And I wouldn't underestimate the creativity of the brokerage sorority and fraternity, if you will, in coming up with products that can be useful. That's number one. Number two, if the risk of pandemic isn't epidemiological, but if it is all just based on government action, well, then that is kind of hard to model, right? Who knows what Boris Johnson or President Biden or is going to do next, right? That creates real difficulty. And so then number three is pandemic the same as terror? Do we need a pan-re or a pandemic tripra, if you will? And that's a question that we still haven't answered yet as an industry. I mean, it wouldn't actually be unusual if it was. I think I was speaking to Patrick Delalot at CCRE, and he told me that in the 1970s, French insurers thought that French drought was uninsurable, right? And before they set up their flood system there. So, or flood and drought system there. But I just think that the industry is creative, and we will come up with a solution. I don't believe that pandemic risk is uninsurable. But one big caveat to that is if the risk is just based on government action, then that is impossible to insure. And if that's going to be the primary driver of the peril, then unfortunately, and I do mean that, unfortunately, there would have to be some sort of non-commercial public backstop. But I think that we as brokers have a duty to find other solutions to avoid that if we can.
Absolutely
or
agree,
as much as we can, I should say. Yeah.
No, and it does seem like we're probably heading down a road towards some sort of public-private solution at some point in future. And Joe, I know this is an area that I think you've put some thinking into on sort of how the ILS market could contribute to those sorts of areas. And what's your perspective? Can the ILS market help to cover some of this pandemic risk, obviously excluding the presidential decree-related risk?
Absolutely, Steve. I think from an ILS perspective, the ILS technology can be used to transfer pandemic risk. In 2017, we had a pandemic catastrophe bond in the market, brought to the market by the World Bank on behalf of their pandemic emergency facility for IDA countries, the poorest countries in the world. The bond was a landmark transaction. It showed that this risk can be modeled, it can be quantified, it can be indexed, it can be transferred. It was received very well by the market at the time in 2017. As I'm sure many of our viewers know, the bond defaulted to the maximum extent it could in April, essentially this year, when the pandemic started spreading. But it defaulted at a time when actually the IDA countries, the recipients of this transaction, were only 1% of the global COVID caseload. I don't think I know of any investors that are disappointed or have any complaints about what happened. And from an investor and ILS technology point of view, the transaction did precisely what it was supposed to do. It has received some negative press, unfairly in our view. I think this pandemic has shown us more than we could ever have imagined in 2017, the value of fully funded capacity when markets dislocate. And that's particularly valuable for countries like IDA countries. Obviously, with hindsight, we can always think of things that can be improved in such an ambitious and complex transaction such as this, but the bank should be applauded for pioneering such very important technology. They've given us a blueprint of how things can be evolved further. And I think once the dust settles, we will see that technology being used again. So that's what the one transaction we've already had. I should say my former colleagues at the African Risk Capacity are designing an outbreak and epidemic program for African member states. And even in the catastrophe bond market just a month ago, we had a transaction come to market for excess mortality at risk to the ongoing COVID transaction. And I believe it was issued within the initial guidance. So this shows you if transactions are modeled well, if they're structured well, there is a market for pandemic risk. And going back to your question initially of insurability, Steve, nothing is insurable to the tune of $2 trillion or whatever the final number will be. But that doesn't mean there's no role for insurance or insurance-like mechanisms in managing this risk. I think we all know that there's more to these tools than just the quantum of risk you transfer. So in terms of all these public-private partnerships discussions that are being held in Washington and in other capitals around the world, I can see a big role for reinsurance and ILS on the back end to help governments manage this risk, not least to provide a pricing signal for the risk, a very important element for policymakers that are designing programs. Equally, an increasing trend that we see with these public-private partnerships is, at least for big private recipients of government assistance, they need to show best efforts that they're trying to manage the risk themselves first. And there again, I can see a role for the reinsurance and ILS market to provide that private insurance solution that could then leverage public assistance. This is going to be my favorite question all along, Steve, but in summary, I think there'll be many opportunities ahead for managing this risk in different ways with insurance-like tools.
Great, couldn't agree more, Joe. And yeah, I think there's some very interesting opportunities as well going forwards for the market to prove itself in this respect. So Linda, moving to you as a sort of from representing a reinsurance broker and risk capital advisor, what's the Tiger Risk view on the insurability of pandemics and bringing risk transfer technology to bear? And also, do you think that this is going to have to be a solution that comes with government support?
Yes, I think that the group has really covered this pretty well. Absolutely, it will involve a public-private partnership. But as the other panelists have alluded to, the opportunity for the industry right now is that creativity and innovation and finding how to parse up the risk. Joanne talked about there is absolutely a role for that collateralized limit, fully funded limit. That will be part of the solution. David talked about brokers creating structures that are interesting. I think the industry has done a great job in getting the entertainment market up and running by providing insurance. If it wasn't for the different entertainment bonds and film bonds out there, a lot of production would not be in process right now. So I think we are going to continue to innovate. And I think that will continue to be the secret going forward. Of course, not every dollar of every risk will be a private solution. And I think partnering with public is critical. But I do believe that we have the tool, the technology, the intelligence to find solutions to keep the pandemic controlled with some insurance solutions.
Can I just say,
Right.
Following on what Linda is saying there, that is such a great summary, and I'm sorry to keep complimenting a competitor. That is such a great summary about of the value of insurance, and I certainly do not want us to be patting ourselves on the back at all at this moment in time. But sometimes the insurance sector gets such a bad rap, maybe sometimes deserved, but sometimes undeserved. But we are one of the cogs in the wheel that's going to get the economy going again. And as Linda said, it is insurance that is enabling a lot of industries, including the entertainment industry, including the events industry, sports, to start up again. And without it, they wouldn't be able to. And the economy and everybody needs the intellectual ability, the creativity, and the skill of the insurance sector right now to get the economy moving again. And I just didn't want that moment to go by without recognizing that.
No, thank you, David. I think you're absolutely right. I think in hand with the sort of elevated perception of risk that certainly exists in society and also in the market now is an understanding that risk transfer is only going to get more important, and risk financing in general, as the world deals with these types of calamities that are going to come along and affect us, unfortunately. But I guess sticking with you, David, looking further ahead, how long do you think the market's going to be dealing with this? I mean, I know Linda said the tail is yet to develop, and obviously a lot of that will be driven by the social factors that come out of the pandemic as well. But I mean, obviously the property claims come to an end when the policies end, likely getting excluded out at the next renewals in many cases. But in other lines of business, credit, trade credit, things like that, have you any feel for how long people will be paying claims for on this?
Well, of course, trade credit is going to be particularly dependent on the economic cycle and whatever piece of the economic cycle emanates from the first and second COVID waves as they are. I think there are two different answers to the question, Steve. The first one is from an accounting perspective, as we tally up the claims and the losses. I mean, again, right now, the most recent information I've seen, even all the way through pretty much the third quarter earnings, we are still below 30 billion in terms of reported claims that we can track. And that is certainly easily digestible by an insurance sector that is on track to write high single-digit trillions of premiums before the end of this decade. So there's that side of the question. And you know, yes, Steve, there will be lines like trade credit that persist longer and are dependent on the economic cycle. But the really interesting thing that I've picked up on this call again from Linda is that, sorry to keep singling you out, Linda, the unknown unknowns, as she described them. Are there mental health effects that we don't know about yet? Are there other epidemiological effects that we don't understand? The vaccine, and I'm in favor of vaccines, okay? But if we rush into a vaccine, we've all lived through the asbestosis crisis. We've lived through the liability crisis. We know what chemicals can do to people in the insurance sector. I mean, I don't want to create anything more than that statement, but really, what are the long-term unknown unknowns to this? Is it another A&E? Is it really that, or isn't it? And so I guess the answer, Steve, is long-term, we just don't know. And that's that is, I think, the driver of a lot of the risk premia for some of the longer tail lines right now.
Yeah, absolutely. And I guess, Joe, on the ILS side of the market, do you think there's the potential that the trapped collateral issue that people have been talking about, do you think the market might find ways to actually roll forwards a lot of that coverage and it may be less of an issue than people are talking about? Or do you think it's going to be another thing that's going to hang over ILS through the next 12 months?
No, as I said earlier, Steve, I think it depends on which segment of the market you're talking about. So capital have moved on. And the other side of the market, it will vary. It depends on counterparty, on investment type, on lines of business, all these things. But the market is working to resolve those issues and will charge for them. There's a cost to trap capital, of course, either just keeping it or finding ways that Linda described some of them of trading forward out of those positions. But we believe it's a market, it's working on these issues, and I think they'll be largely resolved by the end of 2021. You look at the market, and I think investors understand that it's not doesn't have to be perfectly trouble-free. But as I said, there's a great interest in the asset class in general, and investors are willing to be forward-looking on these issues if they see the market is responding as it is.
Okay, great. So I think if the panelists don't mind, we might turn to a few of the audience questions, if that's okay with you. So time to surprise you with some unexpected questions. So first question, if corporations did not want to buy very cheaply priced pandemic coverage prior to the COVID-19 outbreak, what makes the panelists feel that they will now be willing to pay the price that insurers will rightly demand for it at this stage? Let's throw that to Peter.
So it's a great question. I'll start off by saying that. I think I'm going to go back to sort of that I believe there has been a paradigm shift globally in terms of how companies look at risk. Go back to when the pandemic started, and this happened at our firm, it happened at other firms. Everyone had to switch to working remotely, right? And this very conference is sort of evidence of the fact that the world's, and we didn't even think about when we were setting up this conference, we didn't even think about, we're going to do virtual. And well, of course we're going to do virtual. Like that's the new reality, and people have adapted to that. So I think you're going to see the same thing. I think you're going to see a shift. I mean, there will always be folks who never want to pay for insurance. That's sort of, that's a traditional problem that's always going to be there. They don't see the value. But I believe that the overwhelming majority are going to take the alternative view and say, hey, you know what? Our entire world has been turned upside down. The way commerce is conducted has changed dramatically, and we need to react to the new reality. So to the extent that there are opportunities to take this risk and put it in a coverage for it, even if it's only a piece of that, I think there's going to be demand for that, and I think you're going to see a shift in corporate boardrooms the same way that you've seen an evolution with respect to ESG. ESG was mentioned earlier. It was sort of this less of a, you didn't see a lot of it. It was a concept that had come up. Folks were talking about it. It is now into almost every conversation I'm having with issuers and investors. Some boardrooms. So I think this falls in the same category. The tide is turning, and I think you're going to see a change in consumer behavior when it comes to purchasing covers for these types of exposures.
Yeah, no, I would hope the same. Certainly, Peter. I guess looking at the response of industry and corporations around the world to climate risk, they're yet to really start to cover their exposure there, despite having a very clear understanding of the threat that poses to their multinational businesses. So perhaps the shock of COVID has been enough that it will drive them to buy more protection more quickly this time around, which certainly presents an opportunity for the industry as well. Somebody's asking, do we see any clarity in the actual event edition definitions for pandemics in the property line of business? And is there an event in this case for pandemic cover and property risk, and actually should it ever remain in property covers, I suppose, is a question as well. I don't know, Joe or David, would you like to comment on that perhaps?
I think, David, you may have more to say than me on this topic. It seems like, from our perspective, it looks like something that is being excluded. The unintended coverage is being excluded, a bit like perhaps an analogy to be silent cyber for affirmative cyber cover. That seems to be the market's going. David, do you have anything to add?
No, cynically, I'm afraid anything where you've seen a lawsuit in the last 6 months where an insurance company has been sued for something that the insurance company considers extra contractual, that is going to be excluded or attempted, unless it's mandated by government, it will be excluded going forward. Because, I mean, this ain't rocket science, folks. If the insurance company thinks they're going to be on the hook for something that's extra contractual, they're going to specifically exclude it next time. That seems a universal principle. That just gets, though, to the point I was making about the obligation of intermediaries and underwriters to come up with products that enable businesses to continue to function, even where the insurance carrier wants to exclude, for example, physical damage or non-damage BI covers. So you see what I'm saying? It's a conundrum that we're in, and I think that what we should do in the first instance is endeavor to create the products which enable us to facilitate business without a government backstop up until the point where we need it, if that's what it takes.
Great, thank you, David. So actually, I've got another question that perhaps is maybe for you, David, and potentially for Peter, is about reserves. And obviously, we've seen these somewhat under 30 billion of loss reports, which are largely IBNR reserves, I believe. Very few, or a very small percentages, really, claims being paid so far. But how are companies positioned in terms of their reserves for second-order COVID losses, do you feel? Do you feel people are reserving cautiously on this, or is it they go through their books and just reserve off all the policies they think they've got? So I guess, yeah, what are the chances of surprises for some of the big insurers?
I think that, and maybe Peter is ahead of me on this, but I think that current reserve assumptions are becoming more conservative, really universally. When I still haven't gone through all of the third quarter results yet, and I haven't looked at every single insurance company in our composite on a calendar year basis. I mean, we just had Zurich and Generali report today. So I don't know the complete answer, but I do know that in the second quarter, that was actually the first time in some time that we had net reserve releases across the entire composite. And we think that part of that might have been opportunistic to account for some of the expected calendar year quarter reserve strengthening, or just losses, accident year losses that were emanating from COVID. So we think there was a little bit of right pocket, left pocket going on there. in terms of the way people are reserving now, I think it is becoming more conservative. You can see that if you just look back over the last 16 quarters and you look at the calendar year trend for any composite that I can identify. But then, is there scope for surprises? Again, I think this goes back to Linda. Yes, there is, and they are unknown unknowns, and it's not going to be in the spreadsheet that we're all compiling with 27.8. Oh, is it going to be 27.8 billion of losses, or is it really going to be 37 billion.8? That isn't the driver. The driver is the big unknown unknowns that are out there in the future that Linda mentioned at the beginning of this call, and that's why I think there is a general mood of conservatism. But maybe Peter's ahead of me on this, because I know that you're doing this more actively than I am.
Yeah, no, I agree with your comments, David. We have definitely seen a trend towards conservatism with respect to the way reserves are being set. We see that in our rated universe, and we see it elsewhere as well. And I think it exactly builds on the point you're making. There's just huge unknowns here, and so firms don't want to be blindsided. So I think because of that, I think the probability of seeing a huge surprise, at least in the near term, is probably somewhat muted. I think longer term, all bets are off. I agree with what my fellow panelists have been saying. There's just no way to quantify the unknown here. I think in the near term, the balance sheets are very well protective. I think insurance company management in general has been quite prudent in terms of the way they've addressed this to date. And it'll be fascinating to see how this spools out in the months ahead.
Great, thank you both. So there's a couple of questions around sort of the pricing cycle. One saying that perhaps comments seem to suggest that the cycle could be a little short-lived if it's really specifically being driven by risk perception of COVID, on top of obviously losses of the past couple of years. Other questions asking how long do we think the pricing cycle could last, and when do we think it could hit its peak? Is January going to be the peak and a slow, steady softening beyond that as capital flows into the market again? Maybe Linda, have you got a view on this?
Well, thank you. I don't think that we're going to hit a January peak and start tapering off. I really believe that the insurance industry is getting more sophisticated and really thinking in terms of long-term cost of risk. And so perhaps I'm overly optimistic, but I believe that, as an insurance industry, we're getting smarter, we're getting better every year. We need to charge an appropriate amount for the risk that we're taking. And we're in a world of great risk. And again, with the interest rates not providing any investment income cushion, we need to preserve our capital and charge the correct amount. So I'm hoping that we maintain our discipline. I do not believe we're at a point where insurance companies are getting an excessive return. But it's important that we also don't go too far. Don't become greedy. Don't charge more than what is appropriate for the risk involved.
Sure, thank you, Linda. Yeah, it's important that the products themselves remain affordable further down the chain to the actual insurance consumer, of course. And Joe, maybe from the ILS market's point of view, obviously a hardening market at the moment means opportunity, also means potentially a chance for the ILS market to stretch its legs on efficiency, do you think?
Certainly for the outlook for 2021, we see a continued hardening into the year. And as David and Linda just mentioned at the beginning of the call, this is an underwriting-driven hardening rather than a loss of capital hardening. And I think the ILS market and the traditional reinsurance market are in solidarity on that. And I see the ILS market supporting the traditional market as they invariably need in the year ahead and maybe longer. So yeah, I think this is one where both markets are aligned.
Yeah, which does bode well for more persistent hardening, I suppose, this time around as well. David, anything to add on that?
Yes, I can't add anything from the macro perspective there. So unusually, I'll try the micro. If retro hardens at 1/1 the way we think it looks set to harden at the moment, and I don't think anybody's going to disagree too heavily on this, we will, by our reckoning at Howden, in terms of non-marine retro cat XL, we're going to be back in the range that we were post, early post 2004, 05, but not quite to where we were in 07, 08. But the thing about that retro market is that hard pricing environment was actually quite sustained. It wasn't just a spike. It lasted for several years. And what I'm saying is that we're getting back up into that range for the first time really since Hurricane Sandy with retro, by my reckoning. That's the retro market. The reinsurance market, even if we have additional significant hardening at 1/1, we're still not there. We're still some way away from where we were post 2004 and 2005. So that has implications for the peak versus increasing hardening question. And then if you look at commercial and specialty lines, we still haven't got to the peaks that we were at during the last liability crisis. So I think it was Brian Dupereau who said that you spend 1 of 7 years in your career in a hard market, right? And I think that we haven't really had a truly hard market now for quite a bit longer than that. But I think that perhaps because of that and because of the bottom that we're coming off of, there is some scope for additional sustainability this time. Everybody's right. This isn't about capital supply. There's plenty of capital, at least on paper right now. It's about risk premia, and it's also about reverting to the mean, if you will.
Great, thank you, David. And then finally to Peter, we're running low on time now, but perhaps you've got a few comments on that and maybe also on the outlook for 2021 for reinsurers.
Oh, absolutely. No, I agree with my fellow panelists. It does seem that what's driving the pricing changes are underlying trends that would suggest that the pricing will this is not the peak, and that we're going to have sort of a tapering off over time over the next 18 to 24 months. I think from a rating agency perspective, what we're going to see is focus on what management is doing and how companies are responding and how participants are responding. I think this provides tremendous opportunities, as I've said, and we're going to see how management, and in particular risk management, which is a big focus of what we look at from a ratings perspective when we're rating companies and rating transactions, is something that's going to receive additional focus and is a reason we're actually, again, just to repeat my earlier comment, kind of stable outlook in terms of the industry going forward, and look forward to the exciting developments that are unlikely going to be spooling out in the days and weeks ahead. So I thank my fellow panelists for all their great insights today, and hopefully everyone else enjoyed hearing their thoughts on the various issues that we're facing as we move through the pandemic.
Great, thank you, Peter. So with that, I think we're going to wrap things up. We've just run over the hour, so thank you very much to all of the panelists, Linda, Joe, Peter, David. Appreciate you taking part in this. For the audience, we're back in just under an hour now for a keynote speech on peak perils and the climate factor, which should be interesting. And then we're back with 2 more sessions every day through the rest of the conference through to Wednesday. So thank you for dialing in. Thank you again to all the panelists. I really appreciate your participation in this.
Thank you.
Thank you.
Thank you.